it's, you know, it keeps changing, right? Like we're in I think a pretty crappy situation if you're like an old timer Bitcoiner who's purist and, you know, it's about freedom, liberty, cypherpunk, and you know, it's like now it's becoming very, very financialized. We've had the ETFs, you know, plural, multiple ETFs being released in the US, but they're not spot ETFs, they're futures ETFs, so they're back onto the Chicago Mercantile Exchange. So the CMEs are already now getting huge volumes, and it's given these institutional traders a venue to you know, trade on. Like if it's risk off, wow, it's great to sell down on Bitcoin because it's almost a leverage trade on risk off, because it crashes when it's risk off. When it's risk on, it goes up, right? So and it's this kind of funny phase where, like, it kind of reminds me of mid 2019 to late 2020, where you remember where like it was trading, it sort of pumped to 14,000 very quickly from our bottoms of 3 to 4, and then it sort of went sideways. Yeah, 2019, it was like, it was just this euphoric sort of recovery from a 3,000 bottom, 3,500 bottom, and then in a very short, you know, run of things, I think that was highly manipulated short squeezing that got it up there. And then we had a plus token sort of scam billions of dollars, and they were dumping all their ill-gotten gains onto the market. And so 100,000, 150,000 Bitcoins were being dumped, maybe more. And so that marked the 14,000 top, and then we were in this sideways chop downwards from 14,000 to 10 to, you know, down to 6.5, and then it went up again, and then we got a little bit of euphoric, and then COVID happened and it whipped down, and then we got into this, you know, the whole world changed and everyone went risk off for a while. We looked at gold as a safe haven. Bitcoin was being lambasted as a failed safe haven, and all it did was trade this correlation with equities. And you know, and it was kind of like now, right? It's like in this trapped sideways band where it's just trading this correlation of risk on, risk off from macro traders looking at traditional stocks. And you know, back in 2019 to 2020, like if you looked on chain what the investors were doing, they were accumulating, but you just couldn't see any impact on price because the price was really dictated by traders on the futures exchanges. And now that we're much more dominant in futures trading, particularly from institutions on these regulated or the regulated exchange, the CME, with huge volumes now going through it, the price of Bitcoin is not like, it doesn't really reflect what hodlers are doing so much. Some sort of impact, but it's kind of like 5 times or more diluted from where we might have been maybe, you know, early part of last year, where there was a lot of spot buying and that just would determine the price. So yeah, it's kind of a weird phase right now, and it's the market's restructuring is what I say. Like the amount of sell-off we had from 69,000 to, what was that, 32.9K? Like, wow, that was like, there was not much hodlers selling, I tell you. There was just risk off sell down from futures exchanges, and that those traders led the price. They were dumping their futures, their quarterly futures, and eventually the hodlers started selling down, like ever so slightly. And it was quite different from what happened in May. In May, you could kind of predict it, right? You could see the hodlers were starting to dump, and those hodlers were a lot of those guys that were buying in, you know, new hedge funds, institutional money, family offices. They were buying in from that breakout from 20,000 all the way up to 50 to 60,000. Like, there was a huge amount of buying that was underlyingly, you know, spot buying, taking those coins off the exchanges, putting into cold storage for long-term investment. And it seems like a lot of those guys sold off and dumped in May. And you could see that coming. But here, very little people sold. It was a very gradual slide down on on-chain demand, and yet the price was sliding and kept sliding, and it was led by the futures, which was different from what we normally see, which is the on-chain demand supply tends to lead the price action. So it's one of these weird times, and I'm kind of interested to see what the structure sort of looks like and how the dynamics work between all the different participants now that we've got futures ETFs here. And oh yeah, totally. Like the way that the price is behaving right now is so different from where it was in the first half of last year. And yeah, it's changed so many times though. That this is like, I feel like it's like, coming out of the 30,000 bottom that was like sort of June, July, that rally was quite different from others. And I think that was a transition where, in that rally upwards, that was when the futures ETF started to go live. So this is just as my view on it, just seeing how the price is being impacted by in relation to what the futures are doing. Just looking at the two different movements, and it's like the weighting's gone towards the futures a lot more now. And the only difference that I can account for it in between that time is the ETFs that went live in between that time, from the last bottom to now. Yep, I think so.
You do.
We don't need them, right? You can buy Bitcoin. Retail can buy Bitcoin on Square Cash App, right? On Kraken, Gemini, Coinbase, Binance, any exchange you can buy it on. There's no need for an ETF. The only interface into, like the argument for ETFs is to it's easy access for effectively the stock traders, right? And you might say that might be like the older generation, Gen Xers, the boomers that have, they call up their brokers and whatnot. But in reality, I think it's a very good instrument, the futures ETF, if you're an institutional trader, because it's fully regulated. You can either trade the CME or you can trade the equities. But if you're going to buy Bitcoin to hold, you'd be an idiot to buy the ETF that's currently structured, right? Because it's so expensive to hold it. Just the way it's structured, you're paying, what is it? Like you might be losing 15% per year by holding that, because you're buying futures, and futures is effectively holding Bitcoin by renting the house rather than buying the house. Yeah, it's a lot better. Like the rent you pay on that might be 0.5% instead of like 15% per year. I don't know if it would take much volume because it would attract the hodlers. A spot ETF you would buy and you'd be comfortable holding that and paying your management fee of 0.5% per year. Like Grayscale, you pay a management fee of what, an eye gouging 2%, which is highly ridiculous, given the size of that instrument. But then if you're doing like a futures ETF instrument, you might be 10, it depends on how bullish the market is, it might be 10, 15, even 20. Sometimes it goes to 30% annualized to hold that. And so it's great if you're an institutional trader that's in for a 3-day trade or a 1-hour trade or a 5-minute trade, because you don't care about the rent at that point. But if you're hodling, that's critical. Bitcoin's got to now appreciate at 10, 20% per year just so that you break even, versus holding Bitcoin through an ETF versus holding Bitcoin under cold storage yourself, right? So I mean, yeah, like it's the most expensive is a futures ETF. The next would be a spot ETF. The next would be buying the underlying Bitcoin under a custodian solution, they might charge 20 bips, like 0.2% per year to hold it for you. And then finally, you can take the private keys under your own hands, which doesn't cost you anything.